Welcome, my friends. 3M is cutting 2,500 jobs. And it is forecasting a downbeat Q1 as demand weakens. If you follow this channel, you already know that layoffs are basically in full-on mode in technology companies. In fact, there has been so much layoff news that I have had difficulty finding time to cover anything else. Twitter laid off 3,700. Amazon cut 18,000 jobs. Meta laid off 11,000 employees. Google cut 12,000 employees. And Microsoft laid off 10,000 people. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. 3M Co. said on Tuesday it would cut 2,500 manufacturing jobs. Management forecast a gloomy first quarter in their Q4 earnings call last week. 3M is struggling with slowing demand for consumer and electronic items. The downbeat outlook and quarterly results pile more pain on the company. It comes at a time it faces separate lawsuits related to defective earplugs. And also from its use of forever chemicals. Although 3M said in December it plans to discontinue these chemicals. 3M shares fell 4.7% when the news of the layoffs was announced. This is further proof that Wall Street is rewarding basically any company that announces layoffs. 3M joined other industrial majors in cutting jobs. General Electric and Raytheon Technologies. It seems that all of the big industrial companies are taking a hit from inflation in 2023. To some extent had recently lowered investor street expectation, but weak 4Q22 results and softer 2023 guidance, weak demand environment, should weigh on the stock in the near term, Citi analysts wrote in a note. Demand slowdown has extended into the current quarter as consumers cut discretionary spending and rigorous industrial destocking, especially in Asia, 3M said. 3 weeks into January, we are seeing continued slowing in organic sales volume as we start the year, Chief Financial Officer Manish Patolawala said. 3M has been fighting the effects higher labor and energy costs. Management said it would continue to adjust its manufacturing levels. The company will need to reach a new level of spending discipline. At least until demand rebounds, that is. 3M expects adjusted sales in the first quarter to be in the range of $7.2 billion to $7.6 billion. That is down 10% to 15% year-on-year. And it is missing analysts' expectations of $8.34 billion. The company's consumer unit is likely to experience falling demand through the first half of the new year. Consumer business unit sales were $5.30 billion in revenue in 2022. We expect macroeconomic challenges to persist in 2023, Chief Executive Mike Roman said. Sales in Q4 fell 6% to $8.1 billion. Q4 earnings were $2.28 per share. That compares to $2.45 per share for the same quarter in 2021. 3M is just the latest in a parade of big companies suffering from deteriorating macroeconomic conditions. And a layoff of this many employees seems to be in line with what other companies are doing. But so many layoffs because of a weak economy are actually further weakening the economy. So it is becoming a self-fulfilling prophecy. As you already know if you follow this channel, tech companies are laying off people left and right. Google finally announced that it will lay off 12,000 people from its workforce. A slew of U.S. tech companies of all sizes have been cutting jobs amid fears of an oncoming recession. Google CEO Sundar Pichai said that the company will begin making layoffs in the U.S. immediately. In other countries, the process will take longer due to local laws and practices, he said. It's the world's worst kept secret that Google employees had been fearing layoffs. Basically, every other tech company has made substantial job cuts. Shares of Google rose by more than 5% after the news was announced. So, it is clear that Wall Street is rewarding companies that announce layoffs. Tech companies are facing challenges from a number of directions right now. Rising interest rates, inflation, anemic consumer discretionary spending, and overall macroeconomic weakness. This has forced advertisers to cut back on online ad spending. And higher interest rates on cash deposits have diverted investor money away from stocks. Hikes to interest rates from the U.S. Federal Reserve in particular have led to souring appetite for American tech shares. That has clobbered technology shares. The gloomy macroeconomic climate has piled pressure on all public companies to make deep cuts to their workforces. And for profits in general. Amazon laid off 18,000 people. Then, Microsoft announced plans to lay off 10,000 workers. Elon Musk slashed over half of the company's headcount since taking control of Twitter October. Well, my friends, the Google gravy train is slamming on the brakes. Pressures from practically all directions are forcing Google to cut costs. After years of rapid growth and over-the-top profits, and astronomical employee salaries, and unreal employee perks and benefits, the tech sector is now firmly in cost-cutting mode. The biggest names in the tech sector are now heavily in layoff mode. Facebook owner Meta, Twitter, Amazon, Oracle, Salesforce. The macroeconomic environment is weakening. Advertising revenue has slowed dramatically. Inflation is raging in most countries. And central banks are aggressively raising interest rates to fight inflation. Growth at big tech companies has slowed to pedestrian levels. And actually reversed in some cases. Meta has seen 2 consecutive quarters of declining revenue and is probably headed for a third. Netflix had 2 quarters of declining revenue before achieving meager growth in Q3. Wall Street analysts are handing out stock downgrades like bathroom passes in a grade school. Shareholders are getting restless. Profit growth has become the new goalpost. And the era of easy money is over. Of course, it's not just the tech sector. All companies are facing rising costs. And they are all battling with challenging macroeconomic conditions. Cost-cutting and price hikes are the 2 major ways corporate America is fighting inflation. The trend toward layoffs means that consumers are done accepting higher prices. If you follow this channel, you already know the financial narrative of these days. Inflation is raging in many countries of the world. Central banks are aggressively raising interest rates in order to fight inflation. Consumer discretionary spending is weakening as consumers deal with both inflation and rising interest rates. So, corporate marketers are cutting back on ad spending, especially online. Online ad spending is the lifeblood of many big tech companies, especially Google and Meta. So, both companies are being hit hard by these deteriorating macroeconomic conditions. Snap announced a 20% workforce reduction back in August. And in high-profile fashion, Twitter just cut half of its workforce. New owner Elon Musk took charge. HP said that it plans to lay off 6,000 employees over the next 3 years. That the United States is teetering on the brink of recession. And people are having to deal with increasing interest expense for any money that they borrow. Ad revenue from YouTube shrank in Q3 as compared to Q3 of last year. If you follow this channel, you already know that Google is under serious pressure from Wall Street. Activist shareholder TCI Management has said that Google must take aggressive action to trim headcount and salary expense. Google needs to deliver a clear action plan to investors, TCI Fund Management wrote in a letter to CEO Sundar Pichai. TCI Management has a stake in the Alphabet valued at $6 billion. Our conversations with former executives suggest that the business could be operated more effectively with significantly fewer employees, read the letter from TCI. We acknowledge that Alphabet employs some of the most talented and brightest computer scientists, the letter continued. But these represent only a fraction of the employee base, the TCI letter added. For non-engineering staff, the letter read, compensation should fall in line with other technology companies, the letter continued. TCI wants Google to increase its share buybacks. The TCI letter drew specific attention to self-driving division Waymo. TCI says that Waymo has failed to justify its excessive investment. Shares in Alphabet have fallen more than 30% so far in 2022. Google employees have become known for a practice, rest and vest. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.